Okay, today is the exciting part of the business plan. You've been doing all the writing and the narrative of it. Now you're going to do the narrative in numeric form. Okay, and what that means is we should be able to look at the financials and it tell the same story that it does in the narrative part of it. So between the executive summary, which we'll do last, and the financials, should tell the whole story. And if anybody needs to know more details, then they can go to those sections. But Chapter 16 talks a lot about the financials, and we've talked some about this, and a lot of today is going to be a repeat, but I want to focus in on the financials. Everybody says, oh no, the number part of it. Really, if you can look at it as, now I'm going to tell the same story in numbers, then I think you'll be a lot better off. If you start looking at it, it's this opposite thing, and now I've got to do that, and not think about it in the same way you've been thinking about writing your paper, it can get a little scary. I think we've gone over it enough times, and I want to go over it in real detail again today. You may have different questions now that you've started getting into it. But doing the numbers is really, really important, because that's the part that now we write on the back of the napkin. Now we see if this plan that we've all composed will actually, pencil out. Will it actually be something? So we're going to talk about each of those. In the book, it talks about how to read the financial statements. So it's not a matter of you just putting the numbers in the right place, but take a second to say, when you finish and the income statement's finished, does this tell my story about the monies I have coming in, any cost of materials, labor-wise, or materials going out, or that I'm having to expense, and all my expenses? Is it telling the whole story about my people and about my revenue? And if you can look at it and say, yep, that covers it, then you're in good shape. One thing that I do when I grade these, I go through, and every time I see something that should be associated with money, I circle it, and then I go to the financials at the end and make sure they're there. You might want to do that yourself, because there's times you've talked about community service or volunteering that may have costs associated with them. Some of you said that your volunteers, that you're going to pay them when you volunteer to do community service, that your employees that are going to do volunteer work, you're going to pay them hourly. That's got to reflect somewhere. Some of you said that you're going to sponsor a Little League. What does that mean? Buying them uniforms. That needs to reflect in the financials. So anything that has money associated with it needs to be in the financials. That's the part that can trip you up the most, is talking about something and then not putting it in the financials. So make sure you go through and that the two tell a parallel story, the narrative and the financial statements. So each of the financial statements has something different that they're telling. The main ones we're concerned with is the income statement, the cash flow, and the balance sheet. And as we talked, there's the book actually comes with an electronic spreadsheet that we don't use. We use the one that I have provided for you on Moodle. But the cash flow is probably the most important. Just because if you can't have cash, you can't operate. You can't move forward. So even though the business may be showing a profit, if there's no cash, you're going to die. And there are a lot of times you see businesses saying, wow, that place was always packed, they had great food or great service or whatever it was they were doing. Why did they go out of business? But 9 times out of 10, it's because of cash. They ran out of cash to be able to operate. And so you have to have cash to operate. So make sure, again, I want to reemphasize, that cash flow must always be a positive for every month, not at the end of the year. Each month, cash has to be a positive. Just think about your bank account. When does the bank let you have a negative bank balance for just a little bit? Just hang on there. I'll get that taken care of next week. And what's the bank say? You're balancing checks one after the other. And you're going to get some big fees. So that cannot dip below at any point. So make sure that your cash flow is right. It talks about the income statement, and you might want to look through this because it describes some things that maybe you didn't think about. Are you going to do any entertaining of clients where you maybe need to put an expense for entertainment of meals? What about traveling? What about the maintenance of your vehicles if you have vehicles that are linked to the business? Okay? There's a lot of expenses that you need to make sure you're accounting for all of them on the expense side of the income statement. Some of you said that you would travel to some conferences. That is an expense. Okay? So it's the mileage, or if you're flying, it's the airline ticket, it's the hotel, and it's the eating while you're gone. All of that needs to be expensed out. And if you're sending an employee, the same thing. Right? If you're using a vehicle that you already own, you can still take the mileage, and you still need to charge the maintenance against the business. Yes, Addie?
If you have a personal vehicle that you're going to, like, for tax purposes, say you're going to use 50% of the time for business, does that need to go into your financials as well, even if it's not bought just for the business?
Well, I think 50% of the time would constitute that you could write off 50% of the maintenance, 50% of the gas, 50% everything, just like we talked about if you're working out of the home. What you need to do, though, is you need to have a log in the car that says, I started at this mileage, and that was business, and then the areas that you're doing personal needs to be a direct record. So you can say, out of the 2,000 miles I drove this month, 1,500 of them were business, so you need to account for that expense. When we get to taxes, they need to know how much of the vehicle is used for businesses. For purposes of the financials, you need to be able to expense that car out, the part that's being used for the business. Okay, then we have the balance sheet. Balance sheet is probably the one that people have the hardest time with in our balance sheet, because we're not bringing a business forward, that you're going to zero most of those things out. One of the things I got asked this weekend was, where does the money go that I want to put in? I have cash I want to put into the business. Okay, where does that go? It's your owner's equity. But what does it call it on this spreadsheet? What's that? Yeah, but it's not called equity on here. It's in the cash flow statement, and it's actually called, it's considered a sale of stock. Even though you're not a corporation, some of you, we still just call it a sale of stock for purpose of the spreadsheet, but it's actually owner's equity. So any money that you're going to put in, you put it in there for the sale of stock. That's money that you're putting in to start up the business. Sources of funding, you may look at some of this. There's a lot of special loans that are given to women who want to start business, minorities that want to start business, or there's also just small business loans that the government will give. And if you talk to Jack Vitaco at the Small Business Development Center at HEC, he can help you also guide on some loans. So you want to know those low interest rate loans that you can apply for.
Just one question. As I'm American, right? Because otherwise it's gets a lot more difficult.
Yes. For your purpose, you're here, you're American.
Okay.
Yes. We won't forget you're German, but you're American today, yes. Yeah. Oh. So check and see how you're going to do the loans. One thing I did say, though, is take out a loan last. Meaning, fill out all your financials, and even before you put cash in, see where that cash flow, there was that graph on there, and when it dips down, then go add. I've got 10,000 to add in my own person. Put 10,000. If everything raises up and gives you a nice little cushion, maybe you're good to go. If not, and you got 20,000, then put 20,000 in. Don't put more money into the business. And whatever you do not borrow more than you need. So if you don't have the cash to put in, take out small loans until that cash flow starts getting above the negative, and you might want a little cushion there. And then when you see the cash flow go way up, that's when you want to pay off the loan or pay yourself back the money you have invested in it. Addie?
If you have personal money that you're going to be investing, do you need to state where it's coming from?
No, you just say it's owner's equity. You might state that there's a savings, or the owner will be putting in X amount of dollars. You don't have to specifically state. And I know at some point all of you have a great rich aunt that's going to give you the money for this business so that you can avoid all of the things that go on with having to take out a loan. Okay? Yes, I somehow figured that, but there's some of you don't have that great rich aunt, and you're going to have to do a loan amortization table, which you've probably already done in your finance class, but you can also run them on the computer. You put loan amortization in the search engine, they'll pop up. You tell it how much you're borrowing, at what interest rate, which you may have to call a bank, or if you get any of these special types of loans, put the interest in and the number, the period in which you will borrow that money, whether it's a short-term loan or long-term loan.
Can we do like a private, like not through a bank or anything, private loan?
And just call it, is it gonna have, where you're gonna have to pay interest on it? Okay, yeah, you can, you treat it the same way as a bank, but yes, if you're paying interest on it, treat it the same way.
But it doesn't have to necessarily be a bank.
No,
it can be-
no, but you need to know what the interest rate and how long the terms are for borrowing the money. Okay, so you will need to do a loan amortization table. There's a break-even analysis that is done. I have, I think, a little link to that. Also in the financials, there's a break-even analysis form. I am not that big on doing that. In fact, I don't care if you do it or not. A lot of people feel differently about a break-even analysis. Break-even analysis is not ever something you want to strive for, to break even in a business. But why do you think some people want to figure out what the break-even point is?
Just so you know where you stop paying your expenses and actually start making a profit.
Yeah, where's the gravy start coming in? Yeah. And what you were going to say?
Just to make sure you know what levels you have to stay at, or stay above, or
Yeah. Yeah, maybe it's a little benchmark. I mean, I used to do it in my head and know exactly how much I needed to sell. And if I hit that by the 4th or 5th day of the month, I would just go, okay, we're covered. It's just gravy from here on out. I'm not that big. If you want to do the break-even analysis, go ahead and do it. The problem is, if you do it, then you need to be able to explain it. And the way it's done on these financials is a little difficult. So the main ones I'm looking for is income statement, cash flow, and the balance sheet. And what you'll do for each of those, you will provide the first year. If you look all the way at the end of the spreadsheet, there's some tabs that are called reports. And there's a report for the cash flow monthly and a report for the cash flow annually. A report for the balance sheet monthly, and a report for the balance sheet annually, and a report for the income statement monthly, and a report annually. Those are the 6 reports that will be included in your final paper. Those will be appendices under financial statements. Now, there's a little trick to doing copying and getting those into your Word document, because you're going to have to change the orientation to landscape. I've given a video there on how to do page numbers and section breaks, and also how to do a table of contents. All of that's within one video. Okay, so make sure that you read that. It gets a little tricky that you're all in portrait orientation, and then you got to change it to landscape halfway through or near the end of the paper for the financials, because they get kind of long. Now, some of them can be in portrait and some landscape. Usually the annual ones are okay in portrait, but the annual ones get spread out, so you'll need to change the orientation of those. Okay, any questions before I go through the sheet again? And again, I would take the time to read through the book, because it helps with some vocabulary words that maybe it's been a while since you've used, helps you understand how all of these financial statements talk to each other. You can't just do one, and you may notice you do something on one sheet and it changed something on the other sheet, or wait a minute, my cash flow was positive, what did I just do because now it's negative? So you need to be looking at all 3 of them simultaneously, realizing if you make a change on one, it's probably going to affect the others. Okay, so you need to look at them. You also need to look and see, by reading the formula, where that's going. So if you make a change and it changes something else, look at the formula and guide through to find out where that is. You need to be very familiar, and I think I told you this the first week. Be very familiar with how that Excel document is laid out. So if you can't figure out how the numbers are working behind there and why it's filling in other areas, it could get confusing. big word of caution. Do not unlock that spreadsheet or unprotect it. Okay, it's easy to do. You go up and say unprotect. Let me tell you something. If you've unprotected it, you're up a creek, because I'm not going to sit there and try to figure out with you what needs to be put back in, because some of those formulas are this long. Okay? So always make sure you have a backup. I would encourage you to have a backup each day. Save it as the new day. So if all fails that day, you can at least start where you left off the day before, and you don't lose a whole week or two of work. Okay? The only time you can unprotect that is when you're filling in numbers and all of a sudden in the column you see this. What does that mean? That means the column is not wide enough for the numbers that you have. You can unprotect it for 1 second, widen that, and protect it again. So be extremely careful. That is the only exception to the rule of unprotecting it. You do not want to go there. If you accidentally start typing in a cell that has a formula, the formula's gone. Okay? So be real careful. Now, it's not a perfect spreadsheet, because we tried to encompass, when this spreadsheet was made, all the different types of businesses, all the different, whether it's a sole proprietor, LLC, corporation. So there's some things that I want to go over with to let you know. Just for example, the sale of stock is really owner's equity when you're talking about an LLC, opposed to a corporation. Okay? So the first thing that you need to do is finish your financial statements. Okay, so that's your people sheet, your unit sheet, cash flow, balance sheet, and income statement. Okay, we'll go over all of those again. The second thing you need to do is write up, because chapter 16, where it talks about financials, is another section in your paper, just like operations and strategy and all that. You need to write up a couple paragraphs, is all I'm asking, that summarizes your financials. Meaning, as you can see, in year 1, we operate at a negative profit margin. By year 2, it starts to increase. By year 3, we're seeing a profit, or what your sales are. But just something that summarizes that up. Okay? The third part is the assumptions. Okay? You will have a sheet of assumptions where, how did you derive at that revenue for the year? How did that, you lumped all your utilities together. What does that include? Okay? All those different things, you need to make assumptions. If you put insurance and it's $50 a month, I do not need, if it says the type of insurance it is, I do not need it explained on the assumption sheet. But if you've lumped utilities together and it's $5,000, or even if it's $1,000, I'd like to see a breakdown of what that includes. Now, if you have insurance that is $10,000 or $20,000 a year, then I do need some explanation of that. Okay, that your business is extreme risk and that you have to have larger insurance than normal. Okay. So there's 3 parts that are going to be due this week. You can go ahead and just turn in your Excel spreadsheet. Okay, you don't have to do the reports and everything. Just turn the whole thing in. That's going to be one link. And then you're going to have another link, which is your write-up for Chapter 16 about your financials. And the third one is a document that is your assumptions. Okay, so 3 different things are being turned in this week.
You don't want the assumptions on
You can put them on the same, but it'd be easier for somebody to flip back and forth. So I say that you put 3 different documents in there.
Are we going to let us put? Oh, no.
Yeah, because you'll just do a reply to your own. So make sure that all 3 of those are included. The Excel spreadsheet. Now, doing the reports, we're not going to do that for this, because if somebody wants to give you feedback, they may look around in the spreadsheet to see maybe what happened. It looks like you doubled up on your salaries. You've got it in 2 places, so you can tell them those things. Yes, Addie?
If it seems like we're really confused on our financials after you review them, I know you're very busy. Is there time we're going to be able to sit down with you and go over where we're going wrong?
Yeah, I'm always available, and so let me talk about that in a minute.
Okay.
Okay.
We could go bug someone else if you want us to.
No, it's my class. I mean, you're always welcome to, all of us work together as a team, but no, one thing I want to state, and I do want this on the video, you are my busy. Okay, so don't ever say I'm too busy for you. You are my busy. Okay, so remember that. So I will definitely help you out. Okay, so let's start with the spreadsheets again. So you've had time, and we're calling this overkill big time, so maybe one of you could even get up and state this. So on the first page, the things that you're going to do is insert your company name and the year and month in which you're going to start the business. Now, we talked about the importance of the year and the month in what regards?
Seasonality.
Seasonality. Either for weather purposes, right? You may have some seasonality for weather purposes, maybe for school starting, maybe for vacation times. Okay, there's different reasons that you have for starting a business at a different time. Okay, so you need to have an explanation of why you started the business March 15th, okay, or whatever you picked, or March 2015. Okay, the sales. Now, where do you think this information is going to be derived from for the sales?
From your
Capacity.
Sure.
total market potential sales forecast.
That's right. So you're going to take what your sales forecast is, and if you said you're going to sell 10,000 of them, you need to distribute 10,000 units across those first 12 months. Now, it may be equal, but probably not. Even if there's no seasonality involved, it may be you need a couple months to get going, and by the end of the year you get to that point. Or it could even be a dip and then a rise again if there is some great seasonality involved. But that needs to match what you're saying the number of units you're going to sell to end up for that first year's revenue needs to be calculated right here. So when this is done, the revenue will automatically show up on the income statement based on the information you put here. Yes?
Like for my business, should I make that with hours per month, or just writing down how many clients I had?
Well, not every client pays the same. So your units will be hours you sell.
Hours?
Yes, I would think so, there's always a couple different ways, but from what I'm hearing, it wouldn't be clients because they're not all serviced the right same way. It's just like if I had an automotive shop, I couldn't just count the customers coming in because some get an oil change and some get an engine overhaul.
Yeah, sure.
Sure, so I think you would have to do hours.
Hours.
Okay. All right, so what you'll do is put the number of units, and that's going to be based on you figuring out what you said you could sell for the year. Now remember, this is another one of those things, once you filled out all your expenses and you just lost more money and you continue losing money over 3 years, you got to start back at that TMP and figure out a couple things. Do I need to expand my location? Do I need to expand my target market? Do I need to do better marketing? What do I need to do? And then you got to come back and adjust again here. So it's a moving target constantly. Yes.
So my TMP, I issued that the number of jobs that take about an average of 2 hours to complete a job.
Mm-hmm.
And so if I'm doing hourly stuff, would I just automatically put that as like a 2 hour rate? So if it's $35 an hour, just put $70 in the unit price.
Well, you would do whatever an hourly price is. Do you have a minimum that it's going to charge them 2 hours?
No, but I mean, if I'm already averaging in my TMP that each job takes about 2 hours.
Well, then you would just double the number of units.
Okay.
Yeah. So that would be 2 different jobs, or one job that took 2 of your units, which is an hour.
Okay.
Okay? I think that's the same thing we're talking about with Frederick. But once you get working with this, you'll see how it works out. So you put your number of units across, you put what you're selling them for, so that times how many units you're selling should be that revenue amount that we determined was your first year sales. Then you put how much it cost you. Now for some of you that are completely in service, there may be minimal cost. Okay? Or there may be no cost because you put the cost in expense. Like Frederick, if you're driving to their homes, that is a cost for the gas. but would you put it here? Maybe you just put it in a gas expense on the income statement. So you can just lump it all together. Okay? But this is for direct cost. Okay? So if you're making a product, this would be all your ingredients, Addie, everything it took to make those tacos. Okay? For those of you in service business, you may have that. There may be some things, are you going to cost out how much shampoo and conditioner or any other stuff for each haircut? Or did you decide to go the route where they're going to rent the space from you and they use their own products? Okay, so you need to figure out what your cost is. And just because you're in a service business may not mean there isn't any cost associated with it. Or you may be just expressing the cost in the income statement. Yes?
So labor and like utilities would just be an expense you would want to put there too.
Well, are you only paying the repair people of the
No,
computer? They're getting a salary.
Yeah.
So that doesn't go here.
Okay.
Yeah. Now, what is going to go here is any products that you need to use to repair the computer, though.
What if I have, like, if the customer buys the part, would that still have to be there?
No. It's if you're buying the part and charging them for it.
Yeah.
Yeah.
But I'm not gonna have any sell the charge of the parts, because that's one problem. There's not enough spaces with all the services I provide. I'm not making money off the parts, just the labor,
Okay.
just the services.
Okay, but you're charging them for the parts.
I'm charging them what I paid for the part.
Okay, and that's a bad idea. Okay? Why would you charge them what you get for the parts? You're going to get the parts probably at wholesale. And then what are you going to turn around? That's a big part of service business, whether it's computers or cars or anything. You can add a 10% fee on top of that, or 10%. Yeah. Yeah, if I go to the dealership to buy a part and say I still have my license as a mechanic, they're going to sell it to me for a lot different price if you just walk in as a customer off the street and buy it. Why are you going to leave that money on the table? Because you're going to have vendors that after a while are going to give you discounts that you can get the parts for inexpensive. Do you guys know of any place where they say I'll just charge you the same amount as I paid for it? There may be a few, but for the most part, that's money you're leaving on the table that you should.
Okay, I just don't know how to account for it because I already have all the slots pretty much filled up with services. So
Okay.
I don't have, I don't know how to say, plus 10% of the part when all the parts, range from $30 to $150.
Well, there doesn't need to be another slot for the parts. The parts just need to be a cost of materials used for that.
But then it's not being reflected in the pricing.
Okay, let me use Addie's example. She's going to sell 10 tacos, right? And then what she's going to charge is going to be, say she's got a taco, she's going to sell it for, $1. 50 cents of it is materials. Okay, that's not a slot in what she's selling. She's still just selling tacos. So it's not another space. It actually goes in to, you're going to estimate what normal jobs are and what so you've got to come up with some type, unless you just want to expense out all the parts. But it is a tricky thing because parts are going to be different for every single one. But in any particular service always needs a part?
No, not always, but just like hardware,
Okay.
a hardware service would need parts, most likely.
Okay.
Clean the computer at night.
Yeah, right.
Yeah.
If it's all just labor.
Virus control, yeah.
So you're going to have to figure out somewhere that those services are that you're doing on hardware could reflect that there's a cost of materials in that. Because the invoice that you give the customer is going to have labor and parts in a total.
Mm-hmm.
Okay? You need to make some money on those parts.
Okay.
Okay? So you can break it down how much was labor and how much was parts. And so you're going to have to be kind of creative in how you do the unit cost.
Okay.
Okay? And then the difference obviously is what you make on each thing. So again, if it's a service-based general business, you may not have any, but yours is service-based, but parts are going to be needed. Okay? Arvin's is service-based and Frederick's is service-based. There are really no products. Yours is service-based, but there's parts that need to come into it. Okay? It's gonna be a little tricky, but you'll figure out how you can get that in.
Alright.
Okay, the next page is the people sheet, and remember there's two things you need to be aware of. Are you paying your employees a salary regardless of what the sales of the business are? And if so, that is an expense, and that's the bottom part there where it says operating expense. So you would just put how much the owner's gonna make, how much all the different employees are gonna make across the line there. If you're only paying them by the unit, then you put that up at the top so that it will reflect in the percentage of sales that you sell. Yes,
So if you're paying a salary plus a sort of commission,
it's gonna go in two
type deal,
places.
it's gonna go, okay,
Yeah, so you put the base salary below and then the commission at the top.
based on sales forecast or whatever.
Right, yeah. And it's not gonna take a percentage of, so you're gonna have to actually kind
Work
of
that
guess and say,
Okay,
this is
right.
what extra they get, and that's directly related. So the commission part would go down in the expenses, or how are they getting commission? Oh, they're getting commission based on what they do, so it goes to
Yeah,
the top.
based
Yeah.
on their sales,
Okay, all
but
right.
they're also businesses.
Yeah, so you put it in two different places. Now remember, it's not so important where you put it. And Brady, this might be something that you think about, you know, if it really gets complicated of doing that, it's not so important where you put it, it's just that you don't double up. So if you just want to put salaries here and then an expense as commissions,
Because it's only a small bonus, it's not.
yeah, so
half of
maybe
their
you can
income.
put it there and not deal with the top part. Or you could put all the salaries in the top and then none in the bottom, or vice versa. But there is a reason that some go in different places, because sometimes people are looking at your gross profit and your net profit, and it really depends on where salaries are accounted for.
Yeah.
Yes.
So, do you think that we should go through pretty much every part of the financials before we figure out like what the owner's gonna take as a salary?
Oh, definitely. Owners may not get to take a salary the first year, and that's pretty common.
Yeah.
Okay, but what you'll be required to do is say, okay, so how are you gonna live? You say, I'm gonna live off my savings, or I'm gonna live off a partner, or whatever. Live in your truck? Okay.
Eat your own tacos.
Yeah, and eat your own tacos? Well, at least it's food. Okay, so we okay on that sheet? Pretty simple? Okay. Now, this is where it comes in with the income statement, whether you count the salaries as a cost of labor or count the salaries as an operating expense, because sometimes a business will say to you, I will give you commission off of gross profit, and sometimes they say, I'll give you commission off of net income. And you need to know what's coming out of gross profit. If they say strictly just the parts and the materials, say, I'm taking that one. Okay? Or they say, well, all the labor's coming out of that too. You know, I need to look at it. But most of the time you want to choose, but that's why you need to know where the labor's accounted for. I made a deal one time before I bought my business that I wanted my commission off gross profit. And the other guy said he wanted it on net income, and the commission was exactly the same. And I just laughed all the way to the bank because he didn't know what he was talking about. And so I got it before all the expenses were paid for in the business. Do businesses normally do that? No, they need to pay everything and then give you a bonus or a commission. But if anybody ever says, I'll pay you commission on gross profit, you take it. All right? So now that you've filled out all the other sheets, you need to make sure that the tax rates that are on here in the middle of the page are correct. I would make the assumption they are, unless you're in a different state other than Oregon. Oh, also at the top is your short-term and long-term loans. If those rates don't look right, or you got something lower, you need to change those as well.
If you're not taking out a loan, you can just leave those blank.
Yep, you leave them blank because it won't calculate anything. It doesn't have anything to calculate. So notice what automatically comes over is your sales. Okay, that's coming directly from your units, from your sales sheet. And then the cost of materials is coming directly from your unit sheet. Labor, that would also come from the people sheet, depending on if you had cost of labor. If you don't, Look under operating expense, the first one that automatically gets filled in is the personnel, which is the salary for expenses. Okay? It automatically does depreciation. Now I talked about depreciation needing to be accounted for differently. There is on Moodle what did I call it? Has anybody looked at it? A depreciation calculator or depreciation list. Anyway, if you have some materials or you're doing improvements, it tells you what the depreciation should be or if you can even depreciate it. Okay? So look at that and decide. And then you list all of your expenses. And leaving any out can be crucial. You may want to have a contingency plan. You may not be able to afford one. Okay, the balance sheet at the top here, it's talking about depreciation. It's got things like buildings, building leasehold improvements. Some improvements are can be depreciated and some cannot. So look at that sheet and see which ones can. Machinery and equipment, and then it's got automobiles and other equipment. That's usually major equipment, large pieces of equipment. I think at this point in time, unless you're going to have large servers and lots of computers, I wouldn't list them there. If you're just going to have 2 or 3 computers that you just use for the bank business, I just expense them out the first year and not worry about depreciating them. Most computers are under $1,000 nowadays, or at least under $2,000. So whether you're going to use a laptop or something, I think you can just expense it out.
What if you already have a laptop, though? I mean, like,
Then it won't show up anywhere. You're just using a personal one. Yeah. But by year 3, you may need to replace it. So that would be something to think about. Yes?
You don't appreciate phones, do you?
No. It usually has to be a high, I think it used to be anything over 1,000, but I usually say things over 5,000 now because we're replacing them so quickly and the depreciation time and I don't think they could go in there.
can I just make my phone that I have now into my business phone?
Sure, and then
Just
the
start
monthly
paying the
payment.
bill through the business.
Sure, exactly. Are you gonna use it for business?
Sure.
Yeah, well then that's what you do. Yeah.
No one cares.
Well, rather than getting a new phone.
Yeah, and a lot of people carry 2 phones. If I was hiring you and I needed you to be on the phone, I would probably give you a second phone and say, this phone is only for business and you carry your personal phone. I have a friend that carries 3 phones around. That would drive me nuts.
Yeah.
But it's for that because the bills can stay nice and even what's being done through which segment of the businesses. Okay, so we got our depreciations up there. And then here where we talk about accounts receivable, you need to check method 1. The reason you're going to check method 1 is because you're not in a position to allow someone to wait to pay you. You're a new business, they need to pay you up front. Now the standard in your business may be a monthly charge, but go ahead and treat it that it's not going to be passed out through 30, 60, 90 days, that it gets paid in the same month in which it was accrued. Okay? So I would think for all of you, you would have to really talk to me and prove to me that you can afford, because what you're actually doing is loaning money out.
Yeah.
And you're not in a position to do that. So select method 1. For the inventory, you're going to select method 2. And the reason we're selecting method 2 is just to make it easy across the board, because when you select method 1, it automatically takes a percentage of all of your sales or your inventory or your sales and calculates it as your inventory expense. And as we said, there's certain things we don't sell that are in our inventory. If you go to a restaurant, you don't sell the plate, the fork, and the knife each time. That stays in inventory. So what we're going to do is use method 2 here so that we can only put the change in inventory. So across the bottom there, you would just put your initial inventory and it maintains the same. Even though it's doing this, but at the end of month, we usually can say the inventory is back to where it was. There was no change in the inventory. Because as we use it, we're buying it. As we're using it, we're buying it. And so it stays the same. So that's the best way to do inventory. That'll cover everybody. And then again, in accounts payable, just like you don't have the money to loan anybody, nobody is going to loan you money. They're not going to say, oh yeah, you're a new business. You know what, you pay me when you get a chance. 30, 60, 90, 120, whatever you need, you just pay me. They're going to say, you're high risk, I want cash when you buy it. Now, years later, they may then say, this guy is doing good, the business is going well, they pay me cash on time every time, so you know what? I'll start giving you terms. You know, get a little bit of discount, maybe they start selling you different, you've hit a quantity amount that they say now we'll give you terms. Okay? I was fortunate enough because I grew up in the business I was in with friends of family and all of that I was able to give my clients, which were the auto dealers, 30 days terms, but the people I was buying the product from gave me 60 days. That is a very unusual place to be, but because they knew my work ethic, they knew what I did, I could afford to loan the money to the dealers for a month because I didn't have to pay for 2 months. If you can work out a deal like that, that's pretty sweet, but that's not generally how it works. So we say that you can't afford to loan money and you're too high of a risk for someone to loan money to you. So for that one, we also select number 1. Okay, at the bottom of the balance sheet here where it's kind of grayed out, you are not an existing business, so all you do is put zeros all the way down there. Okay? I didn't allow anybody to start with an existing business, and even if you are somewhat taking a business to a new route, I still want you to treat the new route as the new business and zero that out all the way down. That one should be pretty easy. Just put zeros in there, guys. Okay, if somebody calls and says, what do I need to do on the balance sheet? I know they weren't paying attention. Okay, the cash flow sheet. Remember, cash is king, and without cash, you can easily go under. You could be making a profit, but if the cash isn't there, it's hard to keep a business going. So you can see about halfway in the sheet there that there is this graph that's showing what cash flow is doing each month. Do not let that dip even for a second below. Okay, that can't happen. So this is what you're looking at when you're determining how much money you need to borrow or how much money you need to invest. And if this looks really good and you were able not to invest a lot of money and you still got a healthy cash flow, don't. And whatever you do, don't go take a loan out to pay interest on it. Now, sometimes to get this cash flow rolling, you may need to take out a loan that's pretty substantial until things start going and moving. And maybe it's a 3 or 4 year loan, but by month 4, you just needed that to ignite you. Pay it off. Okay? Because that's interest you don't need to be paying on. Okay? So, if you've got a lot of money sitting in cash flow, I better not see that you also have a loan that's outstanding. If you have a lot of money sitting in cash flow and you don't have any loans, then I need some type of explanation of why that money is just sitting there in a shoebox, basically. And what might that be? What might be some explanations to why you've allowed that cash to get up? Amber?
To purchase new equipment.
Okay.
Or if there's something that happens to savings for a rainy day kind of thing.
Okay, yeah, and some of that could be in your contingency, but you're right. If all of a sudden you know that your equipment has a lifespan of 2 years and you need to start getting that cash built up for that, or you want to move from leasing the property to buying the property, or any of those things. But if none of those are the case and that cash flow builds up like that, what would you do in reality? Invest. So you want to put it in an interest-bearing account or invest it. Okay, but this doesn't allow for us to get that cash out. So just make sure that you have an explanation when Mark Siders says, what are you doing with all that money in a shoebox under your bed? And you're going to say, well, I'm investing that in an interest-bearing account, or I'm investing it in the stock market, or I'm getting ready to put a big down payment and buy the property, or I'm going to buy a second truck, or I'm going to buy a whole bunch more equipment, whatever it is, okay, that have an explanation for that. So as we go down here in the cash flow, we've got land. These are things that you're going to buy, okay? The first one that says other current assets and other current liabilities, you can leave those blank. When you get down to the part about cash flows from investing accounts, you're all with me? Okay? Land, buildings improvements. Notice these match the depreciations. Okay? So if you change the name of one of those items in the depreciation, like you say, wait a minute, I've got some unusual things I need to put there, a tractor or something, and you change it, it'll automatically reflect here. So these items are exactly being pulled from the cash flow at the top where you put what your depreciation is. The balance sheet at the top. The income statement. Okay. Looking at these sheets going, yeah. Where you put your depreciation and what you're depreciating, well, let me make sure I did just say that right. Yes, what you're depreciating is on the balance sheet at the top and how many years. Whatever you fill in, those yellow spots will automatically come over, so you'll have the same things here. So you're going to put how much you buy those things for, right? Not what you owe on them, how much you're buying them for. Now, the reason there's other months there is because maybe every 3 months you need to buy that again, or maybe every other year you got to buy that again, or maybe halfway through the year you're going to buy something else. Okay? So it should just be the initial cost of those things. Cash flow for financial activities, this is where your short-term borrowing is going to go. So if you took a short-term loan that first month for $10,000, you put it there. The next item after that is repayment of the short-term loan. Now this is where it gets a little tricky. You're going to have $10,000. The repayment is going to be monthly payments all the way across for that year. The first line is just going to be the $10,000. Unless halfway through the year you need to borrow another $10,000. Okay, so it's going to be $10,000. Those monthly payments that you made are only the principal, not the interest. It's not what your payment is, it's only the principal part. Every payment is made up of two things. The principal, which you're actually paying on what you bought, and the interest they're charging you for borrowing that money to pay on what you bought. Okay? So that's why it's important when you do your short-term and long-term goals, interest rates, that's where it's going to calculate. And notice that on the income statement, it lists about halfway down interest expense, actually almost to the bottom, the fourth line up from the bottom, or fifth line up, it says interest expense. Notice it's already figured out. Okay? That took because you put in how much of a loan, and then it went and calculated the terms of the loan and the interest and automatically put the interest in. So the interest is an expense. The principal is actually for the cash flow statement. So what you have to figure out is how much your payment is through a loan amortization table, and how much of that payment is principal, and the interest is already figured out for you. Okay? When you add those two together, the principal that you put on the cash flow, the interest that shows up in the income statement, together that should be the check you're writing out each month to pay. Now what happens to principal over time and what happens to interest over time? Which one does what? Interest decreases. Principal, you're starting to pay more on the towards. So right now, when you buy a house, you may be paying $10 and your mortgage was $3,000 because it's all going. They want their fee up front in case something happens with the house. So you pay their fee first, then you start paying towards the principal. Okay. So you should see that happening here. That one's going to go up and one's going to go down. Yes. hang on, Ed. If you look on the income statement, under the interest expense, looks like it's not going down much. It's barely moving that first year. It looks like that was a big loan. So it may or may not move, but notice it starts moving drastically in year 2 and 3. It went from 29,000 to 32,000 to 34,000. Okay? Yes?
Does it matter the type of loan? Like if I bought a car and I was getting the loan from the car dealership, still
No.
the same?
Still same. Doesn't matter where it comes from, but if it's a loan you're paying on for a car for the business, it's the same.
But what if you have like a credit card? Like that's part of my contingency plan is a backup credit card. But I plan on paying off
Yeah.
the whole thing every month that I use it. But
So it's more of a safety net, right?
yeah, that's
So
not
you
really
wouldn't
a loan.
count it anywhere, and that brings up another point. If you get a line of credit at a bank, it doesn't show up anywhere in the financials, but it shows up in the narrative. Okay, that I say, this is what my safety net is. A credit card with a $10,000 limit, a line of credit of $20,000, whatever it is. You can you have a line of credit for those times. And once you take out that loan of credit, then it becomes a loan and you start making interest payments on it. Or in your case, you're just going to pay, you can have good intentions. A $10,000 problem happens and you're going to pay it off.
Yeah.
But, so you could state that a credit card is, with a large balance on it, or a large, what am I trying to say? A large limit on it actually is your safety net. But it wouldn't reflect in the financials unless you used it.
We put it in the narrative that we talk about our financials.
Uh-huh. Yeah, exactly. So when you're going to talk about how much money you're putting in, how much you're going to borrow, you can also talk about that you're going to have a line of credit. And you can say how much that line of credit is, but it won't reflect in the numbers unless you use it. Okay? Then we have long-term loans, the same thing. How much you borrowed and then the repayment of it works exactly the same way, the interest and the principal. And then your sale of stock, that's the money that you're going to put in the business. That was either savings or that great rich aunt. You're probably not going to pay any dividends because I don't think anybody's operating as a corporation in here, right? Okay, so we leave that alone. And that's basically it. You starting to feel more comfortable with this sheet? I hope yours is starting to look as ragged as mine is. Okay? So please make sure that before you start randomly asking me questions about what to do with all these things, I suggest that you put them on the general forum, okay, so I can answer it once, or someone else may be able to get to it quicker than I notice on my online classes. They're real good about, she said that on the video, if you go to 0.32, it's right there, and they help each other out and save me a lot of time. These videos are also available to you guys. I expect that you do the same. But put them on the forum. I'll be more in tune to looking at the forum during this, because if I answer the same question 100 times in 3 different emails, probably what I'm going to say to you is, would you post it on the forum? I'll go on there right now and answer it. Or, I already answered this, go check the forum. Okay? But I'd like for you guys to help each other out. So it helps you learn. So if somebody says, what do I do with such and such expense? Help each other out with that. So it's going to be a little interesting how I give the feedback this time on all of these. But what you're required to do is to put the spreadsheet online before midnight, the assumption sheet, and the narrative that you're writing under the financial section of your paper. And then the peer reviews of those 3 will be required as well.
Did you do a peer review of the financials, like on the narrative, or can you do track changes or something on the financial statement?
Excel does, but you know what I would do just to make it easy, because it's going to be a mess with all this. I would make a Word document and say, you might want to double check the salaries. It seems to be in 2 places. Hey, what about your rent? Where are you living in your car? Is this business need a physical location? Because some of you may not have a physical location, but somebody reading the spreadsheet may need to ask that question. Why isn't there anything accounted for a building or anything. Yes.
I was gonna ask about that, because my sales are all gonna be done at the person's home.
Yeah, so you won't have, but somebody looking at your financials will say, wait a minute, there's
Well,
no
I don't have
building
to
you're
have-
leasing.
I don't have to have I can use my own house.
Right, but I don't know if you were here, Carl, when I did that. If you're using a house, you still have my simplicity of my art design. Mark, is that showing up on the video?
Not very good.
Okay, let me see if I can find a black pen. So if this is your fancy house here, and we divide it in, and this much of it is your office space, and that's a quarter of your house, then everything gets divided by a quarter. Your electric bill, mortgage, rent, everything. And so you will have those things. They'll just look very minor because you'll state that you're using a home office.
Okay.
Okay?
Awesome.
So it will show up on there. Yes,
Thank
that-
you.
What about, like, most of my work will be done from the truck or out in the field, but, there'll be times that I do, work on here at home. Do I need to have an office space, even though it's just with a computer?
You could. I mean, for tax purposes, you
Yeah.
probably could. Yeah. So yeah, you can dedicate a part of your home because you could very easily say the truck, the food cart, is not conducive to doing paperwork. It's mainly a kitchen.
Have an office in the food court.
Yeah, you're not probably going to have an office there. So yeah, you could do this. So you may have two different things. You may say office expense and truck. What do they call it? Where you truck space to rent?
Yeah,
Where you
it's just rent.
Yeah. So rental for where the truck is parked, and then rental, and then office space. Okay, so you can have those things. But I really want you guys, and I know you're going, my gosh, I can hardly do my own financials. I'm scared to death. How am I going to look at someone else's? I will promise you it will help you with yours. Because when you see somebody added insurance, you go, oh, I forgot insurance. Or whoops, I forgot that I have to put gas in that car. Or that it's going to need to be the oil changed every 3 or 4 months, depending on the miles I put on it. Okay, so I really need you guys to work with each other very well on this so that you can get the feedback that you need. And I will check the forum often to see if I can intermingle with something that's being said or answer it so that others can see it as well. Now, I may leave it sit there for a little while to see if somebody else answers it. And I'm going to consider that part of your peer reviewing process as well. Yes?
One question. Like, I feel like a lot of my numbers are going to be really random.
I think it's the case for a lot of people for our sales projections.
I mean, like, you told me to do that little table with like the nurse, and I say like, I think the nurse number 1 will have 1 customer in month 1 and so on.
Yes.
So I can do it like that, but for example, like I want to do that like the nurses use their own cards, but I pay them more than it actually would cost for them to drive a mile.
No, actually what you need to do, there is a state allocation for using a car. And
That's
you
a
need to
minimum,
check.
right?
What's that? At a minimum. So maybe it's 15 cents a mile. And so you pay them that to cover their gas, their maintenance, and their insurance.
But I want to pay them a little bit more to.
You can, but I'm just saying, pay
Yeah.
them by the mile, and then you're going to have to estimate how many miles, and that's another
And that's
expense, and it's a vehicle expense.
I was thinking about it like the last hour or something. How do I estimate how many miles 5 nurses gonna drive in 1 year?
Well, you're going to do it monthly for the first year,
Yeah.
and your guess is as good as mine.
Okay.
Maybe your territory at the worst case is only a 30-mile radius, so you know they can't go farther than that for each client. And so they're there, and then are they going to, I mean, you're going to hopefully get them where they're not going the whole 30-mile radius back and forth 8 times a day, but you can figure it out. You know, all of this is going to be your best guess that is reasonable. If you tell me they're going to drive 2,000 miles in a year and you only have a 30-mile radius, 2,000 miles in a month, and you only have a 30-mile radius of where your clients are, then I'm going to be suspicious. So it just needs to be realistic. We don't know. Now, a word of caution, I want you to be conservative in your numbers, but not to the point that it's detrimental. Okay? So if you think you're going to sell 500, put 400. okay? But if you think you're gonna sell 500, don't put 100, okay? You gotta be realistic, but don't be overly ambitious because it's not going to pan out well for an investor. Now, underestimating everything is just as harmful. So you can be on the conservative side, start kind of slow and be conservative. And I know now you're going, great, what does conservative mean? Okay, and I might be making it worse for you. But remember, you're taking the best educated guess based on what you know and what you're finding out from different people. And as long as it's not this big red flag that you're paying somebody $50,000 a month, and that's not what the industry calls for, then we're okay. It's just when things get out of hand and we say, whoa, this doesn't look right, that you're going to be questioned. And if it doesn't look right, but it is, you need to have the evidence to say, yes, in this industry, that's what the average number of miles that a nurse travels. Okay? So I don't have all the answers to those numbers, but that brings out a good point. You have to figure those numbers out. This is all forecasting. It's due to change. Okay?
I have a question about insurance. If we have two different kinds of workers' comp, and then do we just lump it into one and then in the narrative break it down?
You could, and the assumptions.
Or the
Yes,
assumptions,
yes, if you want to categorize areas in the expense because there's not enough slots, you can do that. All of the vehicle maintenance could be the gas, the tires, and all the different stuff you have to do. Insurance could be a variety of different types of insurance.
Insurance quote lumped it all together.
Yeah.
But it did break it down into
Yeah.
what it would be, not the cost of each part, but
Yeah.
what it consisted of.
That's fine. Yeah. Carl?
So if I'm using my own truck,
Mhm.
then I could just have vehicle expenses?
You could have vehicle expenses. What you would do, you would keep a log that shows how many miles that you're traveling. You can expense those miles
I
out
would just say
in
that as the
expenses.
assumption,
Sure.
that I have a log.
Yeah, that this vehicle maintenance is my own vehicle, but I'm
And I-
calculating that 50% of it's going to be used for business.
And I wouldn't have to do depreciation on the vehicle.
Well, you wouldn't have to, but it may be something you might want to consider. Because in the long run, depreciation is going to help you on your taxes. But you can leave it alone and just do an expense. Depends on how old the truck is, too. It may have already depreciated out.
2008.
Yeah, it's probably already depreciated out anyway. Okay?